Textbook we're covering now deals with depreciation. So it would be a good idea to have that one available just in case we refer to it. Business-related assets. Well, the categories of business-related assets are property, plant, and equipment, also known as PP&E. Sometimes we refer to them as fixed assets or just simply plant assets. The property that we're looking at includes buildings, land. The plant assets, the fixed assets, are generally long-term, which means that they're going to last longer than 1 year. They have been acquired for business use, and they are not intended for resale to customers. Depreciation is the periodic allocation of the cost of a tangible long-term asset over its estimated useful life. The purpose of the depreciation is to match the expense of using an asset against the revenue it produces. Depreciation expense is booked or recorded at the end of the period with an adjusting entry. The adjusting entry is a debit to depreciation expense and a credit to accumulated depreciation, which is that contra asset account. The debit recognizes the expense. The credit to accumulated depreciation effectively reduces the balance in the related asset account because it isn't a contra asset account. Accumulated depreciation is a contra asset account. So then you will take the equipment or the building or whatever the fixed asset is, less its related accumulated depreciation to equal its book value. Now, the accumulated depreciation over time is going to increase, therefore the book value of the asset is going to decrease. Once again, the asset's book value is its cost that shows up in equipment, building, vehicles, whatever the fixed asset is, less the balance in accumulated depreciation. There are two kinds of depreciation. We have GAAP, generally accepted accounting principles, the book depreciation, that we use to prepare the financial statements that will update the income statement. That's where we'll have depreciation expense showing. And then, of course, the accumulated depreciation will show up on the balance sheet. We also have the second type, which is tax depreciation. That is used to calculate depreciation for tax purposes, for the income tax return. Tax depreciation can be used for both tax and book purposes only if the financial statements will not be audited, or if the tax depreciation is not materially different from that of GAAP depreciation. To compute the depreciation of PP&E, you need to know the asset's cost, the asset's estimated residual value that we sometimes refer to as salvage value, scrap value, or the trade-in value. We also need to know the asset's estimated useful life in years or in units. Then another one here we need to know is the depreciation method that is being used. Now, generally the cost of a property or plant asset includes all costs required to acquire, transport, and prepare the asset for its intended use. Cost includes, but is not limited to, so this is a general list. It includes the purchase price, the transportation costs to get the piece of property, the plant asset, to its intended destination. It includes the installation or the setup costs. It includes testing the equipment or the property to make sure that it is ready for use. Now, looking at land and improvements to land, Land, although not depreciable, it is the one plant asset, fixed asset, that is not subject to depreciation. We do include land as a company asset, and it is part of PP&E, property, plant, and equipment. Now, so we need to take a look at when land is purchased, what is included in the land's purchase price. So here are the following costs that are added to the cost of the land and are not depreciable. So the cost to acquire the land plus brokerage commissions. We've hired somebody to find that land for us and we have to pay them a fee. Survey fees, which we would hire a surveyor to determine the boundaries of the land on which we can build, make additions, place a parking lot, a fence. So we need to know that. That's a fee that we add to the cost of the land. Legal fees for the attorneys to draw up documents for ownership, for title, to do a title search perhaps even. If there are any back or delinquent property taxes, real estate property taxes that are in arrears when we purchase the land are added to the cost of the land. Any grading or clearing of the land in order to get it smoothed out, to get it ready for our intended purpose, whether it is putting a building on it, whether it is putting a parking lot, those are costs that add to the cost of the land for purposes of the accounting records. Cost of demolishing or removing buildings. So if we purchase land that has a building on it that we do not want to use, and we're having it demolished, removed, razed, R-A-Z-E-D, the cost of doing that is going to be added to the cost of the land. Now, when we look at land improvements are depreciable because they are subject to, they're calling it decay here, deterioration, wearing out. Driveways, sidewalks, parking lots are all land improvements. So they have a limited life. We will cost them out through depreciation. Fences, and there are a variety of fences from wood to chain link, brick. Sprinkler systems, where we put an in-ground sprinkler system in place. That has a limited life. So we separate it from the land and we record its cost, and it too will be subject to depreciation. Lights in the parking lot, another land improvement. Now, keep in mind, improvements to land or land improvements must be recorded separately, so there will be a separate asset account. They do wear out. Land is recorded in its own account. It does not. Therefore, it is not subject to depreciation. The cost of a building includes the purchase price, brokerage commissions, sales and other taxes, expenditures for repairing or renovating the acquired building for its intended use. So if we purchase an existing building and we go in and we take out walls, or we renovate it to put in a new kitchen, those are going to be added to the cost of the building. For machinery or equipment costs, they include the purchase price less any discounts, purchase commissions if there are any, transportation to get the machinery or equipment to the place of intended use, insurance on the machinery or equipment while it is in transit, while it is going from one point to the business that has purchased it, sales and other taxes related to the purchase of this machinery or equipment, installation costs, any tests that are necessary before placing the asset in service to make sure that it is ready, that it is properly operating. Now, here we have an example. On January 1, Abco purchases equipment for $60,000 cash. To record this, we would debit on January 1 the equipment $60,000, credit cash for $60,000. On January 15th, Abco purchases a building for $40,000 cash and a $160,000 note payable. So the building is being purchased for a total of $200,000 on the 15th. You're debiting the building for the total amount. You're crediting cash for what is paid up front as a down payment, $40,000, and crediting the note payable for the remainder, $160,000. Now, SPT purchases land for $90,000 cash and a $120,000 note payable. In addition, SPT pays delinquent property taxes of $2,000, title insurance of $2,500. Title insurance would be where you're purchasing protection in the event the property that is sold to you did not have clear title. The owner that sold it to you did not in fact own it without some kind of attachment. So that's why the title insurance. $4,500 to level the land, smooth it out, make it ready. $63,000 for a fence around the property. $10,400 for a sign near the entrance, so that's our signage, and $6,000 for lighting. So now the question is, how should SPT record the assets? And we have several assets here. We have land, we have building, we have land improvements. So let's see what happens. So part of the cost of the land will be the delinquent property taxes. Those are the taxes in arrear of $2,000, the title insurance of $2,500, and the cost of leveling, grading, $4,500. So we need to add all of those together. They add up to $9,000. We also have the land improvements, the signage, and the lighting. So we have a total of $16,400. So the land, $219,000, that was purchased for cash. $90,000 plus $120,000 note payable. That's $210,000 plus the delinquent property taxes, title insurance, and leveling the land. That's where the $219,000 comes in. The land improvements would be the fence of $63,000, the signage of $10,400, and $6,000 for the special lighting, making a total of $79,400. Cash is being credited for what was paid in cash. The note payable is the $120,000. Everything else was paid in cash. When two or more assets are purchased for a single price, the cost is allocated among the individual assets. The portion of the cost that is allocated to each asset is calculated by dividing the fair market value, FMV, of each asset by the fair market value of the group. So here we have an example. Beauty shop pays $110,000 for a shop and the land it is on. The fair market value of the land is $90,000. The fair market value of the building is $60,000. If we add those two together, that is $150,000. Well, the beauty shop paid $110,000. So they got a better price as a total amount. So they're saving $40,000. So how much of the purchase price should be allocated to the land versus the building? Well, here's how we're going to treat this. The fair market value of the land divided by the fair market value of the land plus the fair market value of the building. And the building will be the fair market value of the building divided by, again, the same total denominator, fair market value of land plus fair market value of building. Well, the land, $90,000, divided by the total, $150,000, means that the land is valued at 60% of the total purchase price. The fair market value of the building is $60,000, once again divided by the total $150,000, and that's 40%. So take note, 60 and 40% is 100% total that we have here. So according to the formula, we're going to take the $110,000 for the land and multiply it times 60%, that gives 66,000. And the building will take 110,000 times 40% to get the 44,000. Now, just as a review, to compute depreciation of PP&E, you need to know the asset's cost, the asset's estimated residual value, also known as salvage value, scrap value, or trade-in value. We need to know the asset's estimated useful life in years or units, and the depreciation method that is being used.